Welcome to the Make It Personal podcast presented by Mutual of Omaha Advisors. Make it personal. It's your money. It's your plan. It's your future.
I mentioned my video producer on the last episode. He's in the room with me every time, helping to make sure that I look and sound as good as I can. Bless him, as he can only do so much with what he has to work with. After a recent recording session, we had a conversation about some of the content and whether or not he was connecting with it. This led to a conversation about other financial topics that were of interest to him. Among the topics he mentioned, he asked, so is the Roth IRA the gold standard? And here we are. I'm going to take a moment to introduce myself for those that may be joining us for the first time. My name is Mark Zagurski, and I'm the Director of Strategy and Communications for Mutual of Omaha Advisors, a division of Mutual of Omaha. For nearly 30 years, I've been involved in the training and development of our financial advisors. Mutual of Omaha, the company founded back in 1909 with a vision to offer affordable, simplified insurance policies that help protect policyholders from financial loss. We reached new customers who had previously been underserved by the insurance industry and backed our policies with superior customer service. Those same founding ideals remain hallmarks of our noble purpose today, as I am here representing the voice of nearly 1,000 advisors across the nation. So where do we start with an answer to my video producer's question? How about better understanding the question? I begin with, what is a gold standard? Since our country was founded in 1776, we've had a variety of monetary standards, including bimetallic systems, where the dollar was backed by both silver and gold from 1792 to 1862. Later, a full gold standard from 1879 to 1933, and even a partial gold standard from 1933 to 1971. The gold standard was a time when our currency's value was pegged to gold, with the physical quantity of gold acting as a limit to the amount of currency that could be issued. We could quickly devolve into a conversation about the pros and cons of a gold standard versus a fiat standard like we've had since 1971, but that's not the direction we're going to take things today. While not directly tied to the gold standard, it makes me think of the statement, as good as gold. According to Wikipedia, this comes from the sense of high and enduring value with literal origins in trade, currency exchange and barter, when any given currency or commodity may be worth as much as gold. So instead of that, maybe what he was really asking, is the Roth IRA worth its weight in gold? In that case, we probably need to take a little bit of time understanding the Roth IRA. I said 30 years earlier, not necessarily to age myself, but to establish the fact that I've been around for a minute. In fact, when I started in this business, the Roth IRA and subsequent Roth 401k were not even a thing. Again, sourcing the Roth IRA entry on Wikipedia, the Roth IRA, originally called an IRA Plus, was an idea proposed by Senator Bob Packwood of Oregon and Senator William Roth of Delaware in 1989. The Packwood-Roth plan would have allowed individuals to invest up to $2,000 in an account with no immediate tax deduction, and the earnings could later be withdrawn tax-free at retirement. Ultimately, the Roth IRA was established by the Taxpayer Relief Act of 1997 and named for Senator Roth, who was its chief legislative sponsor. Immediately prior to the introduction of the Roth IRA, you had the option of a traditional IRA. I guess I should say that IRA stands for Individual Retirement Account. The big difference introduced with the Roth IRA was a matter of choice to the contributor. The basic question was, do you prefer to take a tax deduction now and defer paying taxes on your growth until retirement or when you begin taking withdrawals? Or do you prefer taking taxes on your contribution now or contribute with after-tax dollars in exchange for the opportunity to withdraw your growth tax-free at retirement? Generally speaking, the traditional IRA offers a tax break on the contribution in exchange for deferring the payment on taxes to a later date. And the Roth IRA offers a potential break on the growth at the time of the withdrawal in exchange for paying taxes on the contribution today. Sort of an instant versus delayed gratification thing, though I'll admit that it's a bit more nuanced than that. There are rules as to who can contribute to an IRA, traditional or Roth, rules for who can deduct their traditional IRA contributions. Further rules on the timing and stipulations of taking money out of a Roth IRA tax-free. But generally speaking, the Roth IRA differs from the traditional IRA in that contributions, or what you put in, are never deductible, and if certain requirements are met, withdrawals are free from federal income taxes. It's likely that if you work for an employer that offers a 401k plan, they may have added a Roth 401k option to it. Roth 401k, you say? Yes, whether you realize it or not, if you work for a company that offers a 401k plan to employees, the odds are that you have a Roth option available to you within the plan. According to an article on CNBC.com from December of 2024, over 90% of 401k plans now offer Roth contributions. However, only 21% of workers take advantage. That's up from 62% of plans offering Roth contributions a decade ago. Traditional 401ks is traditional IRA, is Roth 401k is to Roth IRA. Pre-tax or potentially tax-deductible contributions with tax-deferred growth, which is fully taxable on withdrawal, versus after-tax contributions with tax-deferred growth, with tax-free withdrawals, as long as you meet the stipulations. General age 59 and a half, and the account's been open for at least 5 years. So there's a Roth IRA. The majority of employer-sponsored 401ks offer a Roth contribution option today, and then there's something called a Roth IRA conversion. The Roth IRA conversion is as old as the Roth IRA. A Roth IRA conversion is a process of moving funds from a pre-tax retirement account to a Roth IRA, which triggers tax consequences today. Essentially, you're taking money that you would otherwise have to pay taxes on the growth in the future and paying the taxes today in exchange for not having to pay taxes tomorrow. You can convert all or part of the money you may have, say in a traditional IRA, into a Roth IRA. Whether considering a Roth IRA, Roth contributions to your 401k, or a potential Roth IRA conversion, the decision is essentially based on what you believe tax rates may do in the future. Many gurus claim you'll likely be in a lower tax bracket in retirement, while others believe that taxes will be higher due to mounting debts and unfunded government obligations. But how do they know what's true for you? Do you have a plan in place in case it isn't? For us, it really comes down to allowing yourself control, flexibility, and options. That's where a financial advisor can help you to determine whether you should contribute to a Roth or traditional IRA or 401k, or perhaps a blend of both Roth and traditional contributions. Each has different tax implications, and your choice should align with what your retirement goals and tax strategy are. How concerned are you about the possibility of rising taxes in the future? I once heard one of our advisors located here in the Midwest say it this way: would you rather pay taxes on the seed or the harvest? While I certainly don't think that this saying is original to him, it's one that may resonate a little bit more with those in agriculture, though certainly relatable. When you choose to fund or contribute a traditional IRA or traditional 401k, you're essentially choosing to pay taxes on the harvest, a potential tax break today in exchange for a promise to pay taxes on the growth tomorrow. When you choose to fund or contribute to a Roth IRA or Roth 401k, you're essentially choosing to pay taxes on the seed. No tax break today as you use after-tax dollars in exchange for an opportunity to withdraw your growth tax-free in the future. There are plenty of rules that you have to follow, including how much you can contribute, when you can access your money, and for what reasons you can access your money, though the general decision is, do I want to pay taxes today, or do I prefer to pay taxes tomorrow? While this may seem like an obvious choice, though I'm not always certain that it is. So how did I answer my video producer when he asked, is a Roth the gold standard? I told him that it's hard for me to imagine a situation where I've got a bunch of money built up in a Roth IRA or a Roth 401k and being upset about not having to pay taxes on the growth when I withdraw it. That being said, there's certainly an opportunity cost to choosing to contribute with after-tax dollar or foregoing the tax break today. Again, where do you believe tax rates will go in the future? It's anyone's guess, and the best thing you can do is to seek qualified tax and financial advice. If you like the Roth concept, you may also like the concept of cash value life insurance if you also have a need for death benefit protection. I often say, what good would it do for me or my family if we set up a retirement funding plan for me today using a Roth IRA if I don't make it home tonight? I might have some money in that Roth IRA, but if I don't live long enough to fully fund it, then the plan really never takes shape. When used appropriately, cash value life insurance can serve as a financial tool with multiple uses. It can be used in conjunction with more traditional savings vehicles, such as 401ks and IRAs, as a way to accumulate funds for long-term savings goals. This savings may be able to be accessed on a tax-advantaged basis, similar to a Roth, if the policy and withdrawals are structured properly. At the same time, if the insured dies, it provides a death benefit when funds are needed most. Determining the appropriate amount of life insurance, the best type of policy to meet the needs of an individual's specific situation, and planning how to access a policy's cash values can be complex and confusing. The truth about this, as well as other financial goals you may have, is that they can be solvable with the help of a financial advisor. An advisor will start by learning what's most important to you, and they can help you to develop a plan to balance living for today and planning for tomorrow. There's a lot of places out there where people seek financial advice and guidance on personal finance. The thing about personal finance is, well, it's personal. If you want your plan to be personal, it has to be tailored to you. It's never too late to create a plan to give yourself and your family the financial security that you deserve. Take control of your future and schedule a no-obligation consultation with one of our advisors today. Go to www.makeitpersonalpodcast.com to learn more or to get connected with one of our advisors and to download our ebook. Also, please be sure to like and subscribe to the podcast. What role does the Roth play in your overall plan? What is your plan to give yourself the most control, flexibility, and options possible in retirement? I'd love to get your thoughts in the comments below. At Mutual of Omaha Advisors, we understand personal finance is personal, and financial well-being is essential to achieving your life's goals. Our vision is for every customer to be able to imagine, plan, and secure their financial future. Make it personal. It's your money, it's your plan, it's your future.
This podcast is for educational purposes only and may include references to concepts that have legal and/or tax implications. Mutual of Omaha Investor Services, Inc. does not provide tax or legal advice. Please consult with the appropriate professional regarding your personal situation prior to making any financial decisions. Strategies discussed may not be suitable for everyone. Securities and advisory services offered through Mutual of Omaha Investor Services, Inc., member FINRA SIPC. Mutual of Omaha Advisors is a division of Mutual of Omaha Insurance Company.